Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com takes a look at the major markets. He's noticed investors are rotating out of what was hot just a short while ago. He comments on gold and the new FAANG index. InsideTrackTrading.com President Eric Hadik examines the cycles affecting gold, silver, the US dollar, interest rates, and bonds. Is this the time to get in or out of Bitcoin? Founder of the Schachter Energy Report, Josef Schachter, reports from Calgary on how the oil patch is doing, natural gas, OPEC, and whether there could be new trouble in the Middle East. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Ross Clark right after this.
Value from success, growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to the show, Ross.
Good to be back after a little sabbatical there.
Ross, we're seeing some rotation in the markets. Can you tell us about it?
Well, it all started back in sort of the tail end of August. The FAANG stocks had made that fabulous run and then just started to go sideways. And it's the change that started at that point really has come to life here in this last few weeks. And, you always have to be thinking about where the markets are going. You got to be doing the Gretzky style. It's not where the puck is, it's where the puck's going to. And so in the case of the market here, the fact the economic numbers are still really bad, and I saw the employment numbers in the States once again, just really big unemployment numbers this week. But the fact is that with COVID coming to, its natural conclusion with the vaccine in the next 6 months to a year, that's what the market tends to look forward to. It could care less about what's going on today. It's a forward-looking mechanism out there, and that 6 months, 12-month window is, what we were taught way back when. That's don't get caught up in the headlines, because that will only get you in trouble. And, looking at it, we have been narrowed in on things such as the energy stocks. In particular, we were using British Petroleum as one that had done a classic in terms of downside price action into September, October. We were getting signals that we'd only seen historically. We went back over 50 years. We'd only seen this 5 times in the past. And all you needed was a little catalyst on a turn, and you start to get big action. So, you've got the energy markets, the big cap names up anywhere between 50 and, maybe 30 to 50% in the last 4 weeks. REITs, the real estate investment trusts, are just on a tear. Travel stocks, anything that relates to travel, whether it be airlines, the cruise ships, just like CCL or Norwegian, just doing just famously here this last few weeks. And it's all part of a seasonal turn to top it all off. We talked about the early part of November, you start to look for reversals in the market from oversold conditions. And it wasn't just in those sectors that had been beaten up. It was like the S&P and the Dow, which had got down to good cycle lows and got the turn. So things looking pretty good as far as the overall market is concerned. And we could look also at, there's another rotation that's been going on. We had, if we look back over the last year or so, you had that great run in precious metals into the summer. And we got some exhaustion highs up in there. And since then, we've had a pretty decent first correction. We had a pause, and then we've had a second break. Same type of thing we saw back 3 years ago. Big run in the gold market up into the summer of 2017 in a correction. And interestingly enough, at that point, sort of the baton was passed, and Bitcoin became the new leader on the upside. And it went from, in the summer of 17, it was around just under 4,000, and by Christmas, it was just shy of 20,000. And at that point, upside exhaustions had happened. And interestingly enough, that was three and a half months after the gold peak. And if we look at what's happened here, we had our gold peak the first part of August, and here we are at the latter part of November, and we've got upside exhaustions in Bitcoin. So, very curious. And if we take the third part of this puzzle, the stock market had been having, through 2017, a sort of a methodical rise after the gold market peaked out. This time round, we've been grinding our way higher as far as the markets are concerned. And yes, they've been making headlines, but it's been a slow grind up. And if we were to follow true to form on what we saw in 2017, and so far it's looking pretty good, we would start to now see the equity markets really turn on the afterburners as we go through the next 3 or 4 weeks.
Ross, while we were talking just before we went on the air, I was surprised that the FAANGs have their own index. Is that a good or bad thing?
Well, by the time the exchanges usually get around to listing something, or one of the large institutions like a bank puts together an ETF, that is generally the upper parameter as far as a market run would be concerned in any given sector, especially when you come up with new items. And when we saw that happen in the FAANGs, then it's classic here that you would see a top soon after, which is what we've had at this point. You look back to what when the Canadian government approved the marijuana stock, we basically topped out right on the news right at that point. So, and then we came up very soon after with ETF from Horizons, and it's one of those items where by the time something's moved from page 16 up to the front page and everybody's talking about it, it's time to take some money off the table. And here we look back 3 years ago. What was everybody talking about at Christmas? Bitcoin. It was sitting just shy of 20,000. Everybody said you got to own Bitcoin. Well, here we are 3 years later, back and retesting the high. And actually, most of the coins have not recovered back to where they were in 2017. Bitcoin itself, the biggest one, it's back there. But when I take a look at a lot of the other names, gosh, they're still trading at half of what they were back in 2017. So the more you hear about something, the more that everybody knows about it, and the more cautious you need to be. Okay.
Ross, thank you so much for being on This Week in Money.
And look forward to being back with you next week.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on Twitter at ChartsByRoss. Coming up, Eric Hadik next on This Week in Money.
Always consult your investment professional before making any investment decision.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Eric Hadik, CEO and president of InsideTrackTrading.com. He's speaking to us from the Chicago area. Welcome back to the show, Eric, and I hope you had a great Thanksgiving.
Yes, I did. Thank you, Jim, and thanks for having me back.
Eric, just before we get rolling, can you give our listeners just a little bit of an idea about what InsideTrackTrading.com does?
Inside Track Trading is a financial trading and advisory service, focus first and foremost on the futures markets, but also stemming from that, a lot of analysis on stock indexes, cash metals, and things that are very closely related. So it's more comprehensive than just the futures, but that's kind of where we originated, and we provide advisory services for short to intermediate to longer term traders and investors.
How is the gold cycle looking?
Gold remains, I know we've talked about this multiple times before, but from a broader perspective, my outlook for the last 5 years has been that gold set a major bottom in late 2015, and I thought it would set a pair of critical tops, perhaps the end of that bull market in third quarter of 2020, which we saw in early August, and second quarter of 2021, which still, based on current price action, looks like it should be a higher high than the one we saw in early August. So in between those two peaks, I warned my readers that, just because gold may be going to a higher high out in May of next year, which is kind of the more specific time frame I'm looking at, doesn't mean that it's not going to see a significant valley in between those two peaks. And so my intermediate work has been showing since August that we're in a corrective phase, and it could stretch into the very final weeks of 2020 before the intermediate trend starts to turn back up in gold.
Is the silver cycle close to the gold cycle?
They're certainly very close, and many of the key turning points are, same days or within a day or two. But it's the magnitude of those turning points and the comparative extreme of those. And what I mean by that is that you will often get divergence at the intermediate turning points where gold might be heading down to its lowest low in several months, and maybe silver's pulling back to an intermediate low but is remaining above its previous low. So they're both setting lows, but they're different extent of lows within the wave structure. And as I've discussed since earlier this year, I thought that for this final phase of the precious metals up cycles, that 5 to 6 year up cycle that I was just referring to, that I thought silver would be the one leading the way between March of 2020 and May of 2021, and that you would see different inflationary aspects that would help silver more than gold. And even as we're coming into the current time frame, you're seeing the removal of some anxiety over U.S. elections and other geopolitical factors, but removal of those anxiety-creating factors, which then saps the safe haven premium out of gold much quicker than it does taking anything from silver. So gold is the one that's been primed for a deeper correction here, partially due to that, and partially due to the fact that the inflationary factors are continuing to slowly build up and support silver even throughout this correction. So, to answer that question, the cycles are certainly very closely interlinked, but there's different expectations that come from those turning points that I follow and the trends that ensue after those turning points.
How's the U.S. dollar looking?
U.S. dollar is looking certainly weak, and my outlook there has been since earlier this year that we would see a overall decline from March of 2020 into at least March of 2021, maybe stretching out a month or two beyond that, and that the dollar index should get back to its 2017, 2018 lows, which were around 88 on the dollar index. So I think that still is the overall outlook for this time frame, but that on an intermediate basis, the dollar is showing that it could see a 2 to 4 week rebound in December and then prepare for another leg down.
If the U.S. dollar's going down, what's going up?
Well, that's the thing is it's often a case of between the currencies, the healthiest horse in the glue factory type of thing, where you've got fiat currencies as a whole drifting lower, especially when you compare them to precious metals and or digital currency, cryptocurrency. And so we've seen the euro has been rebounding since March of this year. The yen has done a little better than the euro, and yen has had a little bit of safe haven status and premium flowing into it from time to time. And so they're the ones kind of staying a little bit stronger, and as a result of that weaker dollar or coinciding with it, you've seen a lot of commodity prices heading higher, which goes along with that inflationary discussion that I keep coming back to.
Speaking of cryptocurrencies, are there special cycles that's affecting them, and especially Bitcoin?
Absolutely. And since June of last year, I've talked about June of 2019 fulfilled the latest phase or the previous phase of a very consistent 17 to 18 month cycle in Bitcoin. From there, I was looking for that to be a 6 to 12 month peak, but then ultimately give way to a higher peak leading into November or December of this year, 18 months from that June peak, and which was 18 months from the previous, the major peak in December 2017. So you've had this cycle very consistent there, and based on some price work, when Bitcoin was dropping down into the 3,000s back in late 2018, I did a series of reports where I explained a monthly trend indicator I use told me that this was, I compared it to the dot-com bubble bursting in the early 2000s, and that even though that big bubble had burst, it did not mean that it had destroyed the outlook and the upside potential for that market. And similarly in Bitcoin, it's the monthly trend indicator I use, which is a longer-term trend indicator, had not turned completely, it had not turned the multi-year trend negative. And so that told me that Bitcoin should head back up to its peak around 19 to 20,000. And so then it's looking at those major cycle highs as to when a peak like that is most likely. Well, we're coming into late November, early December, right when weekly cycles are also aligning with those monthly cycles, and Bitcoin spiked up to those December 2017 highs, and that's really kind of an ideal point for a very significant top to take hold here. And once we see the final peak set in Bitcoin, assuming it occurs during this late November, December time frame, that I think it's going to be in for another long corrective period.
We'll have more with Eric Hadik when This Week in Money returns.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Eric Hadik. Eric, the Dow broke 30,000 this past week. What's the latest on the Dow cycle?
I think that stocks continue to be in a bullish phase on a 12 to 18 month basis after fulfilling major cycle lows in late March of this year. I continue to explain and illustrate how the price action really since 2018, 2019 has shown a lot of similarities to the period of 1978 to 1982. That's kind of the analog period for the current period. And that's consistent with the 40-year cycle that I discuss so frequently. And I've detailed some of the specific moves that the comparison was uncanny in how close what was unfolding in 2018, 2019, 2020 was to what occurred in 1978, 1979, 1980. And right down to the sell-off in the early part of this year. In 1980, you saw a sharp drop from mid-February to late March, and in 2020 the same thing was shaping up. I did a series of reports in late January, early February, talking about looking for a sharp sell-off into March 23rd, and it's almost exactly what the stock market did, just mimicking what it had done 40 years ago. From there, many of my current indicators were telling me to look for a rally into the third quarter, and that's also what happened back in 1980. And I'm only using that 40-year cycle analog as a very general comparative feature in my analysis. It's a lot of more specific and more current analysis that is corroborating that for me. And so the outlook was for an overall advance from late March of 2020 into May of 2021. You'll notice that that's similar to the outlook in silver, and that's often what you get is stock market will have an inflationary move towards the end of a bigger cycle where it actually gains along with those inflationary expectations until it hits a certain point where then the inflationary expectations become a burden instead of a support to the market. So that's what I think that you're looking at in stocks right now. I'm looking for a late November peak and a quick sell-off in the first, maybe third of December. But then I think you're going to see the uptrend resume in the early part of 2021.
How is crude oil looking?
Crude has been looking pretty positive. It completed a very textbook ABC correction into late October, and indicators started to turn more positive in early November. And the intermediate outlook from my work has been for a second advance from those early November indicator reversals up into late December, although I think we could see an intervening peak right here in the late November, early December time frame. So a little bit of a spike high, a little bit of a pullback, and then another rally into the end of the year. But I think we could see a pretty significant peak at that point, and crude and the energy complex consolidate for a couple of months. But overall, I think that you still could see an upward trend into similar time frame as the metals and as stocks, the middle to latter part of second quarter 2021.
Is the natural gas cycle different than the crude cycle?
Absolutely. They definitely run at completely different synchronicity, different intervals, and natural gas fulfilled a 3 to 5 year cycle low in the first quarter of 2020, and my work at that point and continuing until now has told me that that's a multi-year bottom. We had the front month spike down to around 160, 170 in natural gas. That was major multi-year 10-year support, and that my outlook was for an initial advance into November, December of this year, which we've already fulfilled, a kind of a second wave, which is often your deepest pullback following that, and then a second bull market in the coming year. So even while crude and heating oil and unleaded gas have been rallying since early November, natural gas has been selling off, and so they're almost 180 degrees opposed. But I do think that natural gas has the better long-term potential, and that it could be moving up in sync with the overall energy markets during a large chunk of the month of December, and then during some key periods in the first and second quarter of 2021. There are some phases where the two different cycles appear to be in sync, and again, that could be something that's as much related to an overall commodity inflation period as it is related to specific fundamentals in each of those different markets.
What's the latest on interest rates?
I still contend that we saw a multi-year peak in bonds back in July of this year. That was the recurrence of a uncanny 4-year cycle in bonds and treasury notes. And that peak obviously correlates with a major low in the corresponding interest rates. And I think that bottom in interest rates is going to hold for many years going forward. I'm looking for bonds. They had an initial sell-off into early November, which was when intermediate cycles converged. It's actually, when you look at bonds over the last 4 years, you'll see that they set multi-month lows in early November 2017, 2018, 2019, and now in 2020. So this is kind of a second wave or a V wave rebound in bonds and notes. And I think that they will see another leg down in the first part of next year, which would also certainly be something you'd expect if commodity inflation and dollar weakness and other things emerge as I'm expecting. So that would be something where at least expectations for interest rates would begin to turn a little bit, and longer term rates, traders would be looking at a slight uptick in those rates, and shorter term rates could have even a quicker uptick if we see the type of price movement in some of the metals and commodities that I think we could see at a specific time in the early part of next year.
Is the bond market in sync with interest rates?
Well, that's the case. They're 180 degrees. One's the inverse of the other. So any expectations for bonds, it's the opposite expectation for interest rates. And now, again, it's one of those things where the markets reveal expectations, not always the immediate present fundamentals. And so a lot of what I'm talking about in bonds is the market anticipating certain things, the actual physical interest rate, or at least the rate set by the Fed, might not change at all during that time frame, but traders' expectations and some of the related rates within the market will be oscillating along with those swings in bonds, notes, even Eurodollars and Treasury bills. So there's certainly a close correlation, but the physical interest rates, the ones that many average investors look at, they might not be moving even as the market forces driving expectations are moving.
Are there year-end cycles?
On the whole, nothing consistent enough that I've seen. In this current year, like I said, there are certain things shaping up in like energy markets where there's cycle highs lining up at the very end of the year. There's some in the stock market as well. But in my work, I haven't seen a consistent and tradable enough cycle to really come to that conclusion.
Are there any cycles we should be paying attention to right now because they're about to peak or hit a valley?
Really, kind of what I've discussed is would kind of answer that question with some of the major cycles, I think, set to peak in the second quarter of next year, and so like precious metals, for example, if they can see a bit more selling into the latter part of December, I think that would certainly be a multi-month cycle low. Perhaps one market that is, I think, very close to a peak right now is the soybean market, and I've talked about a 4-year cycle there, and coming into this year, I was looking for a surge in the second half of the year with two major targets, one at $10.60 and the other up at $12, which is a level hasn't been seen in about 4 years. There's a little bit like the cycle I mentioned in bonds, that there's a pretty consistent 4-year cycle in soybeans. And so it's interesting to me that particular cycle and soybeans have shot up to the $12 target, so they're both price and time are coming into play. And really the driving force behind a market like that has been Chinese buying over the last several months, which is tied into the Phase 1 trade deal, which obviously with President Trump likely on his way out in the next several weeks, things could certainly change where China-U.S. trade is concerned, or it could just be the fact that it's reaching a culmination right now of the international buying, and so there's reasons that I'm expecting a market like that to be peaking right in the current time frame. So that's probably one I could pinpoint that's right in this immediate time frame, and there may be some ramifications from that if I'm accurate on expecting a top here.
Eric, thank you so much for chatting with us.
Thanks for having me, Jim.
My guest has been Eric Hadik, CEO and President of InsideTrackTrading.com, Inside spelled INSIIDE. He was speaking to us from the Chicago area. Coming up, Josef Schachter, next on This Week in Money.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Josef Schachter, founder of the Schachter Energy Report online at schachterenergyreport.ca. He's speaking to us from Calgary. Josef, what kind of bright proud bow tie are you wearing today?
I'm on holiday, so sorry, no bow tie, but next time I'm on, I'll definitely put one on, and maybe it'll be a kind of a Christmassy one for you.
Yeah, the listeners will pick up on it, I'm sure. Joseph, people may notice your voice is a little rough, but you've been a very, very busy man. You had 2 webinars in this past week. Can you tell us about the highlights?
Yeah, we do webinars for clients, and we did one for an accounting firm and their clients across Western Canada, and it was to talk about what's going on in the oil and gas industry, and to kind of give people an idea what might happen in Q1, depending upon how quickly the vaccinations happen, and then we all pick up in travel, and then the demand issues for energy. Right now, of course, the case loads are spiking, as we all know. Alberta, has gone into a tougher, restrictive posture. BC, of course, has been doing that. And, in the States, of course, with Thanksgiving, millions of people are traveling by air and more millions by car. If the incidents pick up and the number of people with fatalities grow over 2,000 to 3,000, then the U.S. is going to be in a tougher shape, and we'll be looking at, very bad numbers in Q1. So that might require, more lockdowns, and that, of course, means lower demand for energy. So, if we do see, the more optimistic scenario where people do, masking and social distancing, then by Q2, once we see more vaccinations available, we'll see a recovery in the economy. And crude oil, which is now on the January contract, $45 US, we could be looking in Q2 moving over 50, and then moving into, the 60s in Q3, Q4, which would provide a lot of new cash flow to the industry, and would make stocks do quite well. As you know, the index has gone from, 60 to about 90, on the S&P TSX Energy Index. So a 50% move in the month of November, because of the 3 vaccine announcements, 3 weeks ago Monday, of course, Pfizer, 2 weeks ago Monday, Moderna, and this week Monday, AstraZeneca. All of that has helped to fuel a let's get back to normal, rally, and the stocks have done well. So, and the second one was our normal webinar that we do for our clients on a quarterly basis. And on that one, we did, a review of the markets as we did in the other one. And then we talked about the companies in the third quarter of 2020, how they did, and I mentioned those that had good performance, those that were problematic, where the volumes were down quarter over quarter and year over year, and also their balance sheets were deteriorating, and those were companies to be concerned about, and we're going to have a weak posture until we get to much higher cash flow levels, and that requires higher commodity prices, and also lenders to continue being supportive. And we already have seen earlier this year where lenders have pulled the lines, and we've had companies go into Canadian bankruptcy, and the assets sold off for less than the debt. So I then went into the tax loss selling seasons of the past, and usually if you have a strong November, then the tax loss selling season is the first 3 weeks of December, and then sometimes it'll drag into the first quarter of the following year if there's an inventory problem, and that's the issue of COVID. If we have the worst case scenario and energy demand comes down and OPEC brings back that 2 million barrels they're talking about, and Libya continues adding to their production, then we're going to see prices back off below 40, which means the stocks will back off again. And then I went through individual names, 10 names, 3 of them being oily names, 4 natural gas, 3 energy service that I thought would be great buys, and I gave specific levels that they would be worth buying. So if anyone wants to go in and see the webinar, they need to become a subscriber, and they can just go into our website, and you can mention to them the access through the where our web pages are.
SchachterEnergyReport.ca.
Correct, sir.
Something that may be of concern about future oil supply, the head of the Iranian atomic program was assassinated. And again, some really tough talk going on in the Middle East about it. Does that affect the price of crude?
Well, you're going to have announcements like that, which can at times, if it increases the war posture between Iran and if they believe it was Israel, if they do any attacks, or if there's any attacks on shipping. If you remember, 6 months ago, I think there was attacks on ships where they put mines on the ships, and there was some damage done to them. A British ship as well, if you remember, as well as Liberian and other nominated areas. But the more one that to me makes sense, and why prices had a bounce this week on the upside, was the Houthis fired missiles at a Jeddah gathering system where they had big tank farms and pipelines, and it hit and did some serious damage to one of the large containers. And again, if they have missiles and continue to do that, that could be more of a war premium issue even than Iran. And so there's lots of we haven't had war premiums in oil for a long time, but these two events potentially, and in the case of the Houthi attack did, in the case of this Iranian thing, we'll have to wait and see in the days ahead if there's any further action and who's behind that action. Was it dissidents in Iran killing, or was it an outside force, U.S. or Israeli or whatever?
We'll have more with Josef Schachter when This Week in Money returns.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Josef Schachter. Joseph, anything special about tax loss season we should know about?
Yeah, tax loss season, a lot of people look at it, it should happen starting technically from mid-November, and it legally, you have a 3-day settlement route, so it could even be after Christmas, but historically it ends just before the Christmas holidays on the 24th, 25th of December. So the market, I think, is a half day on the 23rd or the 24th. I'm not sure. That I don't want to see the calendar in front of me. So right up to then is when you can see the worst. We've had a strong November, as you know, and we're at 90 on the S&P TSX Energy Index. So starting next week, I think we'll start seeing pressure on the sector. The effects of the issues that are going to be to watch are and how low we go is, one, the OPEC meeting that's on Monday and Tuesday, and right now OPEC has been saying that they're producing about 9.7 million barrels, or they're cut back 9.7 million barrels. They were talking in January 1st to bring back 2 million of it. The question is, with COVID and people not driving as much, demand isn't as high as they expected, and so there's talk originally that they would cut back between OPEC Plus and Russia, that they would cut back for 6 months and not bring on that production now to July. Now the conversation is they'll bring it back on April 1st, and there's even some like UAE and others that are saying, no, we want it to come on in January, February, because we need the revenues. So the debate and what comes out of that, my guess is it'll be that they'll hold off for 1 quarter and then say we'll revisit the thing at the end of March or in March, and then decide about Q2. The key is going to be, as we talked earlier with Thanksgiving and Christmas for the U.S., Christmas for us in Canada, and then, what happens around the world with Christmas. Do we see another wave of higher fatalities, higher caseloads, and does that require more, stay at home and business lockdowns? And that, of course, would drive down demand. And if OPEC brings on production at that time, and Libya, which was in September under 200,000, is now 1.3 million, and then they're saying by Q1 there'll be 1.6 million. So you're going to have 1.3, 1.4 million more barrels coming just out of Libya. If demand is dropping off by 1 million or 2, and then 1 million comes on from there, it takes away the ability of OPEC to bring on more production. But if they do, that would mean a glut, and that would mean lower prices. So we're trying to give people an idea of what the parameters are. We don't know the answer yet, but if this happens, then these are the kinds of moves that will happen in price of oil. These are the prices that might happen for individual stocks, and here's the kind of action you can take. And we went through that extensively in our webinar last night, 2 hours worth of extensive discussion. And so, for our clients, they were very, very happy to have the ability to hear the presentation and then ask questions along the way. And we had 2 question periods to divide the session between the front section, which was the macro and the overview, and then the individual stock stuff and tax stuff, which was in our second section.
Are there any particular differences between sector and size of that particular market, juniors, mid-caps, etc.?
The best performing area has been the natural gas sector, and the largest Canadian names in natural gas have done very, very well. They're up 150, 200% from the March lows. So that's pretty fabulous in the kind of market where the TSX is barely positive for the year. If we have tax loss selling, maybe they back off by 10, 20%. If we have oil prices back off, the highly leveraged, the oil sands players, their stocks could be more vulnerable, and we could see oily names come down much more. The service sector has bounced, but not very much. There's been 1 or 2 names that have done well, but majority have not done well. And it's even though the rig count is up. I'll give you the data there. The rig count for the United States that came out yesterday. There's 320 rigs working, up 10 on the week, but that's down 60% from a year ago. In Canada, for the whole industry, we were up 1 rig to 102 versus 126 rigs, down 19%. But then when you break it down between rigs working for oil and gas, the oil rigs were 38, down 4 on the week, down from 77 a year ago, so down 51%. But natural gas, we had a 5 rig increase, so rigs working for the Montney and the liquids-rich Montney, up 5 rigs are working on the week to 64. That's up from 49 a year ago, so up 31%. So the only positive real indicator for the activity in the industry has been in the Canadian natural gas, liquids-rich natural gas sector, and that's why those stocks that are focused on that area have had such good performance, because there is, profitable growth for them at this time. And, we're 275 or so for AECO, 280 or so for NYMEX. Natural gas prices are quite rewarding financially to the industry. If you have a break-even cost of 40 and the price of crude is 45 WTI, it's just barely profitable. So the oily industry has still got troubles, plus a lot of these companies have balance sheet issues. The natural gas guys are benefiting, and a lot of them have very good balance sheets, so they're increasing their drilling and increasing their production. And they want to bring it on, this time of year, because you want your flush production to come on November, December, January, February, which is, of course, the key winter months when you have the highest prices.
The Organization for Economic Cooperation and Development said most countries next year will probably have negative growth, but China will be 10% positive. Is that a positive move for oil and gas?
Yeah, China, of course, is, consuming about 13, 14 million barrels. They produce about 4, so all the rest is imported. So if they grow next year, they're going to be needing more product, both oil, natural gas, LNG coming in. So they will be a buyer from the OPEC countries, Saudi Arabia, Iraq, Iran, because they don't care about the U.S. sanctions for Iran. We're going to see, if you look, steel prices, rebar are gone up, copper prices. So the Asian markets are doing well, and there's growth there. There's forecasts for the United States that there'll be negative GDP in Q1, and how bad will be based on how bad the coronavirus, pandemic case count is. So, Canada may face the same issue in Q1, unless there's more stimulus. But the Canadian government has talked that they will probably keep their stimulus in through the end of June. In the U.S., they need to have that more increased stimulus package. And again, does President Biden on January 20th have the ability to push things through Congress? And that's going to be based on those two Senate elections in early January in Georgia. And if they only win one of the two, they don't have the ability to control the Senate, which means obstructionist the Senate. And if Trump puts out before he leaves the White House that he's planning to run in 2024, then, the Republicans in the Senate will be taking their cue from him, which means to be obstructionist and make Biden's presidency horrible, and disruptible, as much as they can. So, there's a lot of wild cards here in terms of, what that'll do to the economy, what that'll do. But for now, we've had a great 3-week rally, and I think the near-term direction, is going to be going south again, into the early months of 2021. And so hopefully we'll get a great new buying opportunity for the sector. And in March we came out with a lot of new names and table pounding buy, an actual alert buy that we sent out. And anybody who bought stocks during that period have seen doubles and triples from even very large companies, and 50% moves on some of the big names, the Suncors, and others that have done well. Even some of the pipeline stocks have done well. I think the next buying opportunity will be one where you want to get to a fully invested position, because I think we're going to see a multi-year bull market in the resource sector, in the commodity sector. We've seen gold, we've seen nickel do well, we've seen other base metals and corn and soybeans and others do well. Energy is a laggard, and again, coronavirus and usage of energy during the pandemic has been, waned and weakened. I think once we get into Q2, Q3, and anybody who wants a vaccine shot can get the shot, I think we'll get back to a more normal. Demand will pick up, and we'll get back to 100 million barrels a day of consumption from in 2022 versus the 94 or so that we're using right now. And so with OPEC's cutbacks, they will be able to come back on in 2022 to full production again. And then, of course, we're likely to see higher prices to entice energy producers to spend money and bring on increased production 2022, 2023. And I think that's going to give us a multi-year bull market, which the index today is 90. It was in the 480 range in 2008. I think it was 380 in 2014 when we had $100 oil, and it's trading just under 91 today. And the low in March was 38.81. So if we can go from, let's say we back off to 60 and we go to, 350 to 400, you're looking at a 5 or 6 bagger in the index. And if you pick up the right stocks, you could see 10 baggers. So we think that, the next low risk buy signal when it comes, and again, that's the when, not an if in my book, you want to be an investor in the names that fit your pistol. And we're saying you want to have a mix between large cap and intermediate and small. We want you to have recommend exposure to natural gas, light oil, and to the service sector. And I think investors who do that kind of diversification will be very well rewarded in the next 4 or 5 years.
Going long term, some jurisdictions, I believe China, California, BC, have mandated that 10, 15 years from now, only electric vehicles will be sold. What does that do for the oil and gas industry?
Well, in California, of course, they said that no new cars can be sold after 2030 that are not electric, but if you own an older vehicle, you can still drive it. So that's means lower demand in California. But my view is that in the OECD countries in Europe and Canada, US, Japan, others, we're going to see a greater use of electric vehicles. I think last year total sales were about 7.5 million cars around the world. The biggest market, over half, was in China. But you go into places like India, are they going to have charging stations? And are you going to have it in South America? Are you going to have it in Africa? So the demand growth, we're going to look for heading into, the future decades is still going to be for transportation, for crude oil, plus for petrochemicals. And so, while we may use less for transportation fuels and mileage will probably improve in cars that use gasoline or diesel, we're going to see more usage over time. There are a lot of forecasts out that even if all of the Paris Accords and Biden's plans come in, by 2030, the demand around the world will still be in the 104 to 105 million barrels per day, but all the growth will have come from these emerging markets, China and India, and Africa, etc., and North America and the OECD countries will have declining consumption. So, like for you take this week's EIA data, the U.S. consumed 19.2 million, down from 21.1 a year ago. So that's related to the coronavirus. But if we end up saying, we need more electric cars, maybe that number goes to 15, 16 in terms of total consumption. But the amount that's used for cars will go down. Maybe more will be for jet fuel and more will be used for petrochemicals. So my view is that in my lifetime and in our children and grandchildren's lifetime, we're still going to see a lot of cars on the road that are using gasoline or diesel. They'll probably be more fuel efficient, and then we'll see a lot of electric cars. For me, the issue, people say to me, Joseph, wouldn't you want to own or drive a Tesla? Or in the years ahead, GM is going to have a lot of new alternatives. Ford's going to have them. Volkswagen, you can, if you want to, if you even want to have a Porsche electric car, you can probably get one in the years ahead. But the thing is, if you're going from Calgary to Edmonton to visit family and drive back, you want to do it without having to charge. And right now the limitation is they can only do, about 300 miles. And of course the distance is 300 kilometers. So you can't go back and forth without having charging stations at both ends. And I think until that happens, I think we're all going to probably have, maybe going 10 years from now, we have for the city driving, we have an electric vehicle, small car to go shopping and, going to do things and visiting their friends, and then have a gasoline-fired, engine to take us a longer distance, simply because the infrastructure is there for getting your car filled with gasoline on the road. It's not there for topping up easily and fast. So you need two things. Is one, longer battery life, faster charging times. The technology breakthroughs haven't happened on that.
And I just saw a study that said even if you go to an electric vehicle, it only makes about a 10% difference in emissions because that electricity has to be generated somehow. And right now, so much generation still comes from fossil fuels.
Yeah, and the key thing is we want to change the mix of fossil fuels for electricity. In Alberta, TransAlta is going to end fossil fuel coal-fired facilities. The Highvale mine's going to close, and by the end of 2022, they're going to be moving to more renewables, but also more natural gas-fired facilities. Right now, over half of the the coal consumption in the world is in China, and then India is the second largest. So those two really have to make the big difference. If we want the planet to do better, we need China to get off of using coal, and of course India is in the same boat, but it doesn't have the financial capability as much as China does. But if that happens, then we'll have less problems with the environment. But coal is the one you want to remove from the mix. Natural gases, of course, there's methanes and there's all the other issues that are there, but it's way lower than the coal issue, and that, of course, will be incrementally better for the planet.
Joseph, thank you so much for being on This Week in Money.
My pleasure, Jim. It's always a pleasure.
My guest has been Josef Schachter, founder of the Schachter Energy Report online at schachterenergyreport.ca. He was speaking to us from my birthplace, Calgary, Alberta. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Eric Hadik, and Josef Schachter. And thank you for listening. If you have any questions for the show or our guests, you can send them to info@howstreet.com. Now stand by for a company showcase update from American Manganese CEO and President Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Right. Good to be here, Jim.
Larry, one of your top guys was at an important conference. Can you tell us about it?
Well, no, we just announced that he'll be attending a conference. He was on a conference a week ago, and we got, good reception. But this one is the Benchmark Mineral Intelligence Battery Sustainability Summit. And what it really is, it's being put on by Benchmark, who are considered now to be the leaders in, the commodities used in batteries, the EV market, the battery manufacturing market, and the recycling market. So we expect to get a decent results out of that. It's not a cheap thing to go into, but we're there. And, unfortunately, we missed out on one they had previously, but they'll be talking to recyclers, and we hope to put our best foot forward. Now, going on to that, we've got things that are happening. On our cathode precipitation reactor, we have the guy that was looking at it, the engineer that was looking at it on our behalf overseas, and he's back now, but he's in quarantine. But perhaps we can, a couple of weeks, we can start, working on that. That's tremendous. I mean, COVID does have its disadvantages. If you're working on anything that's physical, there are certain drawbacks. So we're moving ahead with that. Now, we got a lot of attachments in this. We hope to have news on our pilot plant here next week too. So that is on the agenda. Now, talking about what we're up to, the spin-off is moving ahead nicely. We'll be applying for permits up there shortly, and that's for drilling and exploration. So that is going to be in our kit to get done. So the good part about that is the price of copper is at all 5-year highs, and last time I looked, it was close to $3.40 a pound. So that's looking good. Stockpiles are dropping, and so that bodes well for the price of copper. And I noticed that the copper producers in the junior, smaller area have all made 300-400% gains in the last year. So that bodes well for the company. The next thing we'll be filing our financials here in the next day or two, and those financials are needed to have a special meeting, or maybe a combined AGM and special meeting with our shareholders to approve the spin-out. I can't see anybody turning down, shares, because it's costing them nothing to agree to it. We don't know the formula for the split yet. That's the next step after it. After the financials are done and everything, we hope to be able to get some kind of a feeling. It ends up in front of a judge, and of course he makes the final decision on how the split goes. Now, cobalt price is on a tear. It's gone from about $20,600 per ton to about $27,150 per ton. So that bodes well for us too. As we will be reclaiming cobalt in our eventual commercial plant. That puts us in the field of being a cobalt producer, and people have to think about that. We got we'll be producing nickel, manganese, cobalt, and aluminum out of our process. So that puts us into a supply situation. Now, the general market is certainly the Dow is hanging close to $30,000, 30,000 points. So that that bodes well. I guess the election, everybody's calling Biden. But like as I said earlier, the election, he brings good things to the table, and we've certainly had some good results working with the Trump government, with the Department of Defense and the Department of Energy. So, that hopefully will continue on, and I say hopefully because you never know with the change of government where their priorities lie, but certainly they should lie with manganese, which we'll be working on. We're going to have crews out there sampling in about a week's time. So that's the start of the whole thing. Then it has to be shipped up to Cometco, and then we can start testing the material. So, everything's looking really good, Jim. I mean, we're moving ahead in all fronts. And again, I want to remind everybody that Zarco will be speaking on the benchmark on our recycling process on the 11th of December, and mark that date down, and you can join the conference. There's a link that you can click to on our last press release. So, it's all looking good, Jim. The only thing that we have to do is get through this COVID thing and move the project on. You got to remember that we're building a plant and a technology that will give us close to 100% purities and 100% recovery, and that's crucial to us. Now with this new morphology of the particle size, we've got that piece of equipment at the lab. We're just waiting to activate it, and that'll put us in front of the battery manufacturers themselves, because again, as I said in the last podcast, that'll make us a battery material manufacturer for cathodes. So it's all looking good, Jim.
Larry, for people new to the company, what are you all about? Where are you traded, and how can they contact you?
American Manganese is a critical metal company that has just recently got a contract with the U.S. government to test the Wendon stockpile, which puts our feet back in the door on perhaps getting something going at the site. And it's from that actual recycling process, we built a recycling program around cathode materials, and the patents that we own on manganese were the cornerstone of that, where you can find out all the information you want at AmericanManganeseInc.com. We're traded on the Venture Exchange, the TSX Venture Exchange, under the symbol AMY. We're traded in the U.S. under symbol AMYZF, and we're traded in Frankfurt under the symbol 2AM. You can contact the company at 778-574-4444. You can email me at LREAUGH@AMYMN.com.
Larry, thank you so much for the update.
You're welcome.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on November 27th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.